Hey everyone, welcome back to Corporate Dakota. SFNC, Simmons First National Corporation, just filed their latest 8K, and I am seeing a big shift in their long-term incentive plan that shareholders just approved. Quick note, this is not financial advice, just my take on public filings for educational purposes. The main story here is about shareholder approval of an updated stock and incentive plan, which includes more shares and some key changes for directors' compensation. Simmons First National Corporation, a regional bank with about $3 billion in market cap and nearly 3,000 employees, held their annual shareholder meeting on May 13, 2026. The big news is that shareholders approved a new version of their stock and incentive plan called the Amended and Restated Simmons First National Corporation 2023 Stock and Incentive Plan. This plan was originally approved back in 2023, but it has been updated and shareholders just gave it the thumbs up. So what has changed? Well, the company is increasing the total number of shares they can issue through this plan. Originally, it was set at a certain amount, but now they're bumping that up by a significant 355,000 shares, bringing the total to 735,000 shares that can be granted. This means they're planning on using more stock to compensate their key people. Another important change is how they will pay their board members who aren't full-time employees. There is now a cap of $750,000 per year for their combined cash and stock compensation. This is a way to keep a lid on director pay, though they can go over this limit in special situations. They've also extended the life of the plan. It used to expire in 2033, but now it will be good until May 12, 2036. This gives the company a longer runway to use stock incentives to keep their top talent motivated. Why do companies do this? The stated goal is pretty standard. They want to encourage long-term growth and profitability by giving employees, directors, and consultants a reason to work hard and make decisions that benefit shareholders. It is all about aligning incentives. This plan allows for a variety of ways to award compensation. Think stock options, which give the right to buy stock at a set price. Stock appreciation rights that pay the difference in stock value, restricted stock awards that give stock over time, and performance-based awards that are paid out if certain company goals are met. They can also give out cash bonuses tied to performance. So basically, the company can continue to grant these types of awards until May of 2036. Any awards already given out will still be honoured even after that date, according to their terms. To put that share increase into perspective, they are essentially adding more than 3.5 million shares to the pool of available stock for these incentive plans. This is a significant boost and indicates a strong focus on equity compensation. The Compensation Committee, which is a group within the board of directors, will be in charge of deciding who gets what under this plan, what the specific terms are, and if performance targets are met, they have a lot of discretion here. One important detail is that all awards, whether they've been earned out or not, are subject to clawbacks. This means if the company discovers misconduct or if certain legal requirements kick in, they can take back previously awarded compensation. This is a standard practice to ensure accountability. Now, let's look at the shareholder vote itself. The annual meeting in May 2026 covered several topics. Shareholders voted on setting the board size at 14 directors, electing those 14 directors, giving their opinion on executive compensation, approving the company's auditors for 2026, which are Forvis Mazars LLP, and importantly, approving that new stock and incentive plan we just talked about. First, ratifying the board size. The vote here was overwhelmingly in favour, with over 125 million shares voting to keep the board at 14 members. Only about 650,000 shares voted against it. Then came the election of directors. On average, the directors received a very strong for vote. For example, James Brogden received about 109 million for votes compared to just 1.4 million against votes. Looking across all the directors listed, they all had a substantial majority of for votes. There were some broken non-votes, which means some shareholders didn't instruct their brokers on how to vote their shares. Next up was the say on pay vote, which is a non-binding resolution on executive compensation. Shareholders voted about 99 million for to approve the pay and around 11 million against. This is a pretty good result, showing general support for how the top executives are compensated. Although there is definitely a segment of shareholders who aren't fully happy. The ratification of Forvis Mazars LLP as auditors also passed with flying colours. Over 121 million shares voted for it, with only about 5.3 million against. This is pretty standard and shows confidence in their independent oversight. And finally, the big one, approval of the amended and restated 2023 stock and incentive plan. This passed with a strong majority. About 106.9 million shares voted for it, and only 3.6 million voted against. This shows that shareholders are comfortable with the company using more stock for compensation and are in favour of the updated terms. including the extended duration and the new director pay cap. This outcome aligns with the recent news headlines that mention shareholder approval of this expanded plan. The filing also lists exhibits, and importantly, the full text of that amended and restated 2023 stock and incentive plan is included as Exhibit 10.1. The report is signed by C. Daniel Hobbs, who is the Executive Vice President and Chief Financial Officer. Looking at the big picture, Simmons First National Corporation is a well-established regional bank. The approval of this expanded stock incentive plan suggests management is focused on retaining and motivating key employees and directors over the long term. The strong vote of confidence from shareholders in these key areas, especially the incentive plan and director elections, is a positive signal. The say on pay vote, while mostly positive, does show a portion of shareholders have concerns about executive compensation, which is something to keep an eye on. In essence, the company is positioning itself for future growth by investing in its human capital through equity incentives. The risk I am watching is how effectively this increased stock compensation translates into tangible shareholder value and profitability over the coming years. What I am actually looking for is a continued pattern of strong financial performance to justify the increased equity dilution. And the research tools I actually use are linked in the description. They help keep this channel going. Stay decoded if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description too.